Welcome back to the Week in Markets. My name is George Bell, Portfolio Manager, and I'm delighted to be joined by Joe Forward, one of the Senior Investment Analysts on the team. Joe, quite a bit of ground to cover this week. If we look at markets in general, they have been more positive after a bit of a wobble on Friday. As a recap, on Friday, the US reported their labour market data, and whilst we saw jobs added to the US economy, there were fewer than what was expected. We saw a revision down of the previous month's numbers, and we saw the unemployment rate tick up very marginally. So market got a little bit spooked by those results, but generally through the course of this week, we've recovered much of that. In terms of some of the key events which have happened this week, we've had a number of corporations this time, not just countries, corporations in America who've been providing big investment and spending pledges into the US to try and avoid some of the harsher tariffs which Trump has threatened. We've had corporate earnings, which have generally been quite robust, fairly buoyant in the US. And we've had a major decision from the Bank of England in terms of interest rates and how they voted to take these down. So we'll take these in order. We'll maybe start there with the large investment packages which we've seen into the US, with maybe the key example being Apple.
Yeah, and exactly. If you look at start maybe from where Trump is, what Trump's looking to do, essentially is looking to increase investment into the US. One of the key ways he's been doing that has been threatening tariffs against these companies and then saying, well, if you invest X amount in the US, then you'll be exempt from these tariffs. So last week, he actually implemented or suggested he was going to do 100% tariff on semiconductor imports. And the key case study into this was probably Apple. So back in February, they pledged a $500 billion spend on manufacturing in the US, mainly sort of linked to their AI. They did this in Texas. So in Texas, they're going to be building a factory. They're going to be doubling their budget for manufacturing within the US, and they're going to build academies as well. So to build a sort of education around manufacturing. Including this, there'll be 20,000 jobs added, and so that was pledged in February. Now in the last week, they've actually increased this spend, so it's going to go from $500 billion up to $600 billion. So it is a significant, increase in that. I guess similar companies, so like TSMC is an example, who are one of the largest semiconductor manufacturers. They actually pledged within their earnings call $165 billion spend into the US, so a heavy investment there. I guess the key question is, would these companies have done this spending had Trump not leveraged these tariffs against them, and what effect will it have on margins? And that's maybe a nice segue into some of the corporate earnings that we've heard about this week.
Yeah, absolutely. Tariffs featured quite heavily in the earnings reports from the second quarter of this year, but generally corporate health has been pretty robust, despite the fact we've had an elevated inflation regime. We've had interest rates which are some of the highest we've seen in a number of decades. If we look at where we are in terms of the earnings season so far, around 2/3 of the top 500 companies in the US have reported. Of those, 82% of the companies are reporting earnings which are stronger than expected, so their profits are higher than what they were actually guiding to. And if we look at how much profits are growing through the quarter, they're up around 10.3% on average. So that's quite a material increase in terms of the profits. And the margins of these businesses are amongst the highest that we've seen in many decades as well. Unsurprisingly, tariffs feature quite heavily in the commentary. It's been a key area of concern around what it means for businesses in terms of their cost base, but also in terms of what it means for consumers and ultimately their revenue. So really important. They are going to face higher costs because we have got a higher tariff base internationally now, but they've got a bit more certainty, a bit more clarity, which they can then plan around. So the starting point is fairly robust for corporate America, and maybe a little bit of clarity could ease some of the concerns around earnings as we look forward. But certainly been a big tool which Trump's used to beat countries, but also companies with, and this is one of the ways in which they're working to get around this, investing in the US, working with the US to try and evade some of the larger tariffs which have been threatened. Other news in the UK here, we had the Bank of England's interest rate decision, quite an interesting one this time round. I think it was largely priced in that we were going to get a cut, but what was it we saw on the day?
Yeah, it was, as far as MPC meetings go, it's probably one of the more dramatic ones. So for the first time, they actually had to hold 2 votes. And as you say, it was cut as expected from 4.25% down to 4%. But within that first vote, so you had 4 members deciding to hold rates. You had 4 asking for sort of a quarter point cut, which is what was expected. And then you had 1 member actually looking for a 0.5% cut within there. So they had to re-vote again, and actually that member who was wanting sort of a heavier cut changed his vote to just a quarter point. So it was as expected, but you know, it really does show that there is uncertainty around the MPC and what sort of rates they're expecting to have.
So if you split the camps there, you've got those who are in favour of taking interest rates lower. What were the key motivations for that?
Yeah, so they'll be more growth focused, so they'll be looking at things like the labour market, wage growth, which have been weaker, and even just growth itself, so sort of GDP, you know, it's been a bit of a struggle within the UK. I guess the ones that are actually looking at holding, they'll be more looking at inflation and thinking, well, we've still got this problem. You know, they've actually revised some of their inflation forecasts higher. So September expected to peak at 4%. You know, we've still got this problem here. We shouldn't be cutting rates.
So you've got 2 camps there. One who are looking at really the disinflationary impulse, which we've seen, which is the economy's chugging along okay, positive growth, but that aspect of positive growth is at risk because they are seeing some fragmentation in the labour market. Also, some of the stronger data which we saw in terms of GDP at the beginning of the year, quite a bit of that was suspected to be front-loading of the purchase of goods ahead of tariff implementation. So just a little bit more concerned about the growth aspect. And then, as you say there, those who are looking to hold, just seeing this risk to inflation. Essentially, their expectations for this year is inflation's going to run at double their target rate, so hold interest rates for a little longer. So quite a bit going on through the course of this week. Generally a better week for the markets, pretty well digested in general. But we look forward to bringing you up to date next week here on the Week in Markets.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.